Essentially, let me bring this back. I was saying how we had basically this weekly profile. It's considered a classic bullish expansion week where we have a Tuesday low, a Thursday high. Monday and Friday are typically the open. So if we look at the open, high, low, close, we'll have Monday open, then we'll have Tuesday print the wick, Wednesday become the expansion, Tuesday create the high, the retracement will create another wick. Oh, I didn't. And then Friday will be the close. This will typically print out your open, low, high, close right here. And it looks exactly like this. So, as we can see here, we want to be looking for PD arrays in discount at the beginning of the week for a draw on liquidity for the low of the week. Typically, you want to see it form on a Monday or a Tuesday, primarily on the Tuesday. You'll find Tuesday, Wednesday, Thursday create the expansion of the weekly candle. And then eventually you'll find that Thursday will become the high, and the draw on liquidity will either be a high time frame PD array or a higher time frame high. And essentially you'll find Friday become the retracement back into the weekly range, which is known as your TGIF. With this in mind, let's break down what setups we could have used throughout the week. Now, my personal model is essentially this. I only look for high time frame PD arrays, and I base my model off of that. So we're gonna start with Monday right here. So starting on the 4 hour, if we look at the previous week, so this is the previous week right here. This was last Thursday. We printed this displacement candle here, leaving behind a fair value gap. So Thursday, Friday continued lower. Sunday through Monday, we retraced back into the previous weekly range. So if we drop down into the 1 hour or the 15-minute, better yet, we will find that we left behind relative equal highs right here. And this is all liquidity the market was going to target. Now, typically what you want to see is the best kind of liquidity are either equal highs or relative equal highs. And you'll notice how the market will always gyrate to these levels. Now, it's even better when you have a higher time frame PD array right above an like equal highs or some sort of important high, because that can indicate a reversal, just like we saw here. Price swept the highs right there. Swept the highs, tapped into, remember this was the 4 hour PD array. This is the SIBI right here on the 4 hour. And what I like to do is I like to start on the 4 hour. When price taps into the 4 hour, I like to drop down into the 15-minute and look for a 15-minute PD array. Because the market, typically what it does at the 4 hour, you can't automatically just drop down into a lower time frame. It'll tap into the 4 hour and it'll seek some sort of PD array in the past to deliver off of, and that's typically what it does on the 15-minute. So we can see here it delivered off of a 15-minute order block right there. Let me get rid of this. This 15-minute order block right here was delivered into. So now at this level, we can now drop into our time frame of choice. And this was actually the paper trade we took on Monday, just to get ready for the week, and it was a winning trade. Well, we took this one right here, but if you essentially want to target, if you want to look for more setups, this is what you're gonna look for. So let's get rid of all this, and let's simply just focus on our attention on the 15-minute order block and the 4 hour imbalance, which is this big gray box. So equities open, market opened at 9:30, right? So 9:30 open was right here. 9:30 open was on this candle right here. Price displaces higher, right? And if you guys have been with me in my calls, you guys know that at 9:45 I like to look for a reversal, because according to quarterly theory, from 9 here we go. So from 9 to 10:30, which is the 90-minute cycle, this is considered our distribution phase, right? This is considered our distribution phase. Now within this 90-minute cycle, if we cut these up into 23-minute cycles, which are its own quarters, so from, here we go, 23 to 45, which is where we expect the reversal, to 10:08, we have our own microcycles. So we would consider this accumulation, which is quarter one. This would be manipulation, which is quarter two. This would be distribution, which is quarter three. And then either continuation or reversal during quarter four. This is called X. AMDX, quarter one, quarter two, quarter three, quarter four. With this in mind, when market opens, we expect the opening move to be a Judas, which is the fake move. All right. So with this in mind, now that we know that this is the Judas swing higher, we would assume that when price taps into this 4-hour BISI with the 15-minute order block right there at the high, we would want to see a reversal, and this is where we can find a setup. Now the setup is essentially higher time frame PD array, lower time frame liquidity sweep, right there. Do we have an imbalance on the liquidity sweep leg? Yes, we do. As you can see, it's right there. Let me make it darker so it's more noticeable. On this liquidity sweep leg, on this low time frame liquidity sweep, we have an imbalance right there. Price closes below it. There's two types of entries. You can enter on the close below, or you can enter when price wicks back into it, when it retraces back into it. If they're in super close proximity, I would just prefer to enter on the close below and just endure the drawdown since they're in close proximity. But what if this candle closed down here, or maybe down here? I would personally not take this trade since we already swept internal low right here. Or maybe if we start sweeping lower lows and we're either retracing back into it right away, or if the fill is bad, I would prefer just to not take the trade. But since the close below was not sweeping this low yet on this candle, then that's a nice fill. And your targets, you have two different types of targets. And actually, all the entry criteria and everything is in the recent thread I made on Twitter, going over what to target and how to enter. So I already went over the entry criteria: high time frame PD array, low time frame liquidity sweep, imbalance on the liquidity sweep leg, close below. That's your entry criteria. Now for your targets, what can you target? So you can be as simple as just targeting lows. So these can be your targets right here. And eventually, this low right here. You can be as simple as that, or you can start to use your standard deviations. Now, each come with their pros and cons. In my personal opinion, I like standard deviations because it tells you where price can potentially reverse and you can get more out of the move. For example, let's use common sense here. And you use your standard deviations on the liquidity sweep leg, by the way. So if this standard deviation right here, let's use wick to body. If this standard deviation right here lines up with this low, we would assume that price is going to go to this low. So why would we target this low and give up some gains instead of targeting this low right here, right? So that in itself would be a nice 36-point play. From entry to exit, 36 points. Now, if I remember on Monday, we took this trade and we took partials here and then we started targeting this low. Now, once again, if we use common sense, look at where the second standard deviation lines up with. We would assume, okay, price is going to go to the 1 to the 1.5. It's going to retrace, reaccumulate. Then it's going to redistribute back down to the 2 to the 2.5 because it lines up with this low and it lines up with this low right here. Now, it obviously didn't do that. Price ran liquidity one more time, and then provided once again another model entry, just on a different time frame. Now, as you can notice here, so you guys understood that first model, right? Before I move on to like maybe another model we can use. All right, for sure, for sure. So that's model number one you could have used in the AM session. Like this is something like you're in and out probably in the first 15, 30 minutes of the market. You're already done for the day. Now let's use this same common knowledge and apply it to another potential model. Now once again we're delivering still within this 4-hour imbalance, so we're still bearish until obviously the higher time frame shows us that we're bullish. But we just continue to look for shorts. This is just simply a liquidity sweep, an internal liquidity sweep, right? Now you see this liquidity sweep here. How many imbalances do we have on this liquidity sweep leg? How many imbalances do we have from this candle right here, from that low to this high? And that's one liquidity sweep leg. How many imbalances? How many fair value gaps? 4? Not quite. 2. Yeah, we have 2 imbalances. So we have one right here, and then we have one right here. Now, if you guys know me, you guys know that I prefer to look for a liquidity sweep leg that only has one imbalance. The reason being is one can get confused here as to which one to enter off of. So our entry criteria is, remember, once again, 4-hour PD array. So we have a, or higher time frame PD array, better said. This just happens to be a 4-hour. Let me just do 4-hour SIBI. So this is the 4-hour SIBI right here. Now within this 4-hour SIBI, once again, low time from liquidity sweep. We have 2 right here actually. And then we have 2 imbalances. I prefer 1 because if we have 2, one may say, all right, well, if we close below the one above, so if we close below this one, I'm going to go short. But what is price doing? Now it's going to deliver off of the one below. See that? Now it's delivering off of this one, and now you're going to eat up all this drawdown right here. You're going to eat up 26 points of drawdown to this high. And most likely you're going to be stopped out. Now, if we go, now this is the 1 minute. If we go to a different time frame, oh, it's going to reset my chart here. It's right up here. On a different time frame, this is why you want to cycle time frames when you're trading. Always be cycling time frames. On the 2 minute, now this looks a little better, right? Now it looks cleaner, more like much more simpler, right? So on this 2 minute, maybe even the 3 minute, it will allow you to clean up the space and look for one imbalance. So let's see if the 3 minute has maybe a cleaner one. Sometimes on the 2 minute it can have one. Let's see what the 3 minute says. Okay, yeah, the 3 minute also has that one. So the higher time frame you go, the better the setup is. It'll give you a higher probability. So like right here, you see this 3 minute now? So no, the 3 minute has one. Now let's see if the 5 minute has one. I like doing this when I'm trading. I like cycling up to the 5 minute. If there's a 5 minute provided, it's even better. So now here it gets tricky because now we're no longer looking at a small leg. Now we're looking at this. Now the leg is from here to down here. Now we're looking at this entire leg. Why? Because we're not looking at this leg anymore because now the swing point, which is the internal low, has transitioned to this low. Why is that? The change in the state of delivery becomes this order block, right? So this entire order block right here, these down close candles, now move down. They shift down to on the 5 minute. Now you'll understand what I mean when I go to the 3 minute. So remember what I said on the 5 minute? The order block or the change in the state of delivery, meaning if we want to see a shift in order flow, on the 5 minute, you're going to have to wait all the way below these 5 minute candles. But on the 3 minute, where's the shift in order flow? It's this order block right here, right? So it's much closer. So we would consider the last liquidity sweep leg these up close candles past the order block. You see once price closes below this order block right here, price begins to shift bearish. Now with this in mind, this is where I would consider all that, and I would say, all right, that's going to be my last liquidity sweep leg, and this is where I'm going to start to look for the imbalance. So the 3-minute would be the most optimal setup in this scenario. Did that make sense, guys? I know that was a bit more confusing than it should have been, but hopefully that made sense. Yeah, made sense? Alright, perfect, perfect. So since the 3-minute is the most optimal, we're going to basically project everything off the 3-minute, whether it be low-hanging fruits, targets, and whatnot. So with this in mind, this setup looks like it's going to be a 1030 reversal setup. Yeah, like right here. So if you guys know when I talk about time, you guys know that I expect reversals at 9:45, which is that quarterly shift, and then reversals at 10:30, which is typically, if we look at the 1-hour candle, the 10:30 will typically induce some type of reversal. And if we look at the quarterly 90-minute cycle, remember what I said from 9 to 10:30? From 9 to 10:30, that's our distribution. So there's another quarterly shift at 10:30 on the 90-minute cycle. So it goes from 9 to 10:30, that's 90 minutes of time. From 10:30 to 12, which is the last cycle of the AM session, that's the last quarter. What do we expect after distribution? So remember what we talked about? Accumulation, manipulation, distribution, reversal, right? So distribution, 10:30 hits, reversal. Just something to keep in mind. It's nothing important, but anyways, I need to stop getting sidetracked. Price, we wait for a close below, so low time frame liquidity sweep, displacement leg, close below. Where do we get it? It's right here. This is your close below on this candle, closing below the bullish fair value gap. And we wait for a close below. Why? Well, we wait for a close below because if we're respecting a bullish PD array, we want to see price disrespect bullish PD, like bullish PD arrays, bullish order blocks, bullish fair value gaps. We want to see a shift in market structure. Fair value gaps provided the shift in market structure. Order blocks provided the change in the state of delivery, the shift in order flow. So sometimes we may disrespect fair value gaps, but respect order blocks. We want to see both become disrespected for a true dip lower. So with this in mind, we close below right here on this candle. Let's place our TP there. Typically my stop is 25 points. That's a very, notice how price never went up there. Alright, and where do we target? Now, like I said before, you can begin to target low-hanging fruits. In this scenario, the closest low-hanging fruit, the closest swing would be this one right here. Now, in my personal opinion, I mean, 13 points is pretty good if you're like going pretty heavy size. But I like to target, you know, significant lows. So this would be TP, this would be, I mean, I guess you can say TP1, but in my personal opinion, I would prefer to target this low. Because this was the low that was made during the AM session. Remember, market opened right here at 9:30. Market opened on this candle. This candle was respecting this imbalance right here. So this is all accumulation right here. Price manipulated lower, accumulated positions for these longs. These longs need to get stopped out, so price is going to target these stops right here. Alright, another way to target, so that's like more of like you're kind of eyeballing it. Alright, I think price is going to go to this low, but where is it going to go? This is when you start to use your standard deviations. Now, first standard deviation, like I said, remember what I said about measuring your standard deviations with lows? Now, this standard deviation, the first standard deviation, now we know it's going to come down to this low. Why? Because now they both line up. When a standard deviation lines up with a low, you can assume price is going to deliver to that low because of the measurement. And eventually, you know, you can target the second standard deviation. And if we look to the left, lining up with this low, with the second standard deviation right here, lines up right here, and we can expect a reversal right here, which occurs right here. Price reversed as soon as it took this low, reversed higher. So, like you can catch, I mean, insane plays as long as you know the model, the model setup. So right here, let's say you risk 25 points, which, I mean, this play it only went up 13 points, but 25 is a healthy amount. And you target you target 66 maybe on your first partial, and then maybe if you have another runner, you target your last position. That's a nice, nice 4R on the day for the full position. If you were gonna do full TP at TP1, then it would be a nice 2.5R. But that's Monday. Typically Monday you don't see setups like this, but um, you'll find pretty good setups off of a 4-hour imbalance. In my personal experience, you'll find really good setups off of this. So that's Monday. That's Monday AM session. I don't really look at PM if AM is clean. This is Tuesday. Tuesday, in my opinion, was kind of cheeks. I'm not gonna lie. Yeah, Tuesday. When you see a fat expansion like this in the AM from 9:30 open, straight dip lower, then typically like the rest of the AM session is gonna be choppy like this. But let's see if we can find anything off of this. Let's go to the 4-hour. I always start on the 4-hour, look for any PD arrays. So this is Tuesday. We're going to be focusing now on this section right here. If we look to the left, we do have a 4-hour PD array. But then it gets kind of confusing because we closed below it on the higher time frame. So in my personal experience, when price closes below a 4-hour imbalance, I would typically assume we might as well just come to this low. We're just going to dip lower. But in this case, we obviously didn't. There was probably a 15-minute imbalance. Remember what I said about from the 4-hour, you got to go to the 15-minute? See if price likes to sweep or tap into any PD arrays. So price taps into the 4-hour. Let's look to the left, any PD arrays or any lows. Okay, yeah, there were some equal lows here. You guys see these equal lows right here? Low, low, low. It did sweep that, so I do believe it was seeking that. So let's say we had this in mind as we were coming down to this low. So now let's drop down to maybe the 1 minute and look for a 1 minute internal model that we can find. Now typically, look at this liquidity sweep leg. What do we notice about this leg? This is the last liquidity sweep leg right here. How many PD arrays do we have within this leg? Do you trade EU? No, I only trade indices, but you can use this in Forex. You can use, like, it works literally on crypto. Like, this model works on anything. I wouldn't try like silver, gold with it. Maybe just maybe like just currencies. Don't try metals with it. I've never back tested it, that's why. But I do know Forex works. I do know Futures works. I do know. Yeah, yeah. Crypto also works. But we have too many imbalances on this liquidity sweep leg, right? One, two, three, four. Four imbalances. So what did I say? We move up on time frames, right? Let's go to the 2-minute. Okay, now we narrow it down to 3. So potentially the 5 minutes where it's going to be at. Yeah, so the 3-minute has 2. The 5-minute should have 1. Okay. Yeah, we have 1 on the 5-minute. Perfect. No, we actually have 2 now. So you see? You see how now the leg, now it moves all the way up here? So now we gotta go back to the 3. Because the 3, yeah, on the 3-minute we only have 2. But you see how the 5-minute had 2, but the 5-minute candle wasn't, it was like all the way up here? So I prefer when the imbalances are on the lower segment of the leg. So if we take our 50%, notice how these two imbalances are closer to discount. So if we want to be going long, we want to be going long closer to discount and we don't want to be going long closer to premium. All right. So with this in mind, we're going to be looking for a close above the one on top. Remember, like I said, we don't want to be looking for a close on the one below. We want to see a close below the one above because that'll basically tell us price is disrespecting bearish PD arrays. It's going to be looking for a run higher. So this is the 4-hour SIBI. We know we're delivering into and off of a 4-hour PD array. And we just took out 15-minute internal lows, these equal lows right here. So in my opinion, I personally wouldn't trade this. This is probably like a C setup. Like if you guys saw Monday, that was like A plus setup. Those were A plus setups right there. Those are A grade setups. This is like a C right here because we closed below a 4-hour. We have the 15-minute isn't that clear. Typically, if I go from the 4-hour to the 15-minute isn't clear. Like maybe we just swept lows, but we didn't really tap into anything. Like we have more lows right here we could have taken. Like we could have just kept dipping lower. So it wasn't as clear. So this is maybe like a C, maybe like pushing a D. So the grade isn't good on this one, but if we were to try to take a trade off of this, Yo Kiss, have you thought about using 30-second inverses? Honestly, yeah, there probably would have been a 30-second inverse on this, huh? Because of that last leg. I never really like wanted to have like a second chart, but there probably was like a 30-second inverse on this leg right here, huh? This order block, this last leg that swept one more time. Yeah, yeah, you're right. I've never really wanted to dip lower below a 1 minute, but that's why I still haven't bought like TradingView Pro. I just have like the essential. But probably in the future, once I like the 30 seconds valid, oh, I'm gonna have to cop TradingView Pro then. Bet, dude. I'm gonna have to backtest that. You said Top Step X. How do you even get Top Step X? Is it like an invite only thing or what? Yeah, I've been hearing about that fire drill. $4.50 is crazy. Bet, bet. Alright, well, yeah, I feel like there was like a 30-second model right there at the low. But on the 3 minute, we closed below. I mean, we closed above the last 3 minute, but then we dip lower. Now, this personally would have stopped me out if I were to enter long here, because I mean, my stop is typically at 25 points right there, and there was a close above a 3 minute. So this would have personally stopped me out. Now, some may say in hindsight, oh, but what if you wanted to enter off the one below? Because that's what price did. Price delivered to the one below, found support off of this inverse, and then delivered higher. But we don't know that. That's obviously in hindsight. So that's why I categorize this as a very low probability setup. Yeah, we were within a 4-hour PD array. We took out a 15-minute low, but there's some setups, guys, that you have to know when to take it, when not to take it. Typically, when a pretty telltale sign is when the low time frame doesn't give me a clear model. Like this 3 minute, like on the 3 minute, we have two, right? And then you would expect the 5 minute to have a clear model. Like, and then if we go to the 5 minute, the model isn't clear. Like, yeah, we do have one, and it did close above it. Right there. It did close above it. But we still have one above right here. So it's not as clear as you would want it to be. So when the model isn't clear, just don't take the trade. Just be patient. That's kind of a telltale sign. Yeah, Tuesday would have been like a D setup, honestly. Not the best day to trade personally. Wednesday it would have been, so this was FOMC actually. And we actually caught a very beautiful trade on Wednesday, but I personally got stopped out break even. Some members took profits. Um, I stopped out break even because I didn't take profits at TP1, and that's why it's kind of important to take profits at TP1. I'll show you guys right now. I think it was on the 1 minute chart. Let's go to Wednesday. Yeah, it's right here. All right, so the premise was off of a 15-minute imbalance right here. So FOMC candle at 2 made a 15-minute imbalance, right? So let's just keep this in mind and let's go to the 1 minute. All right. So as price was developing right here, as price was forming, we saw it tap into this 15-minute and we were pretty bearish. I'm not going to lie. We were bearish for FOMC. But once price tapped into this 15-minute, I said, I want to see like a fat close below this 15-minute. Like I want to see it just completely disrespect it, keep going lower. Because what I saw was all these equal lows right here. And I was like, we're going to want to come down and take those equal lows. All of these right here. But when price started delivering off of, you see how I marked out the 50% of this 15-minute right here? When price started delivering off of the 50% right there, I was beginning to see like, all right, I mean, we're respecting a 15-minute PD array. We're most likely going to want to tap into, I believe there was a 4 hour up here. Um, or was there a 1 hour? Oh, it was this high right here. I think it was this high. Hmm. Oh no, I was talking about Thursday's accumulation. For those of you that were in in the build remembers, Thursday on a lower time frame, if we go on the 5 minute, last Thursday, you guys see this like accumulation right here? I said we're gonna want to target this because this looks like an original consolidation to a market maker buy model. So consolidation, and they're just low resistance. Like each makes a lower high. Each high makes a lower high. It doesn't sweep the previous high. High, lower high, lower high, lower high, lower high, dip. So with this in mind, typically market comes back to those. So if we go back to our model right here on the 1 minute, because that's where we found the model. Was it on the 1 minute? Was it on the 2 minute? Okay, let's actually review this right here. So this is the high, this line right here. This is the hourly high. Oh, my bad, quick. So I wasn't reading ch the chat. This was the only one and it worked. Okay. I see. Yeah, it wasn't on the liquidity sweep leg. It was an internal sweep, but not on the liquidity sweep leg. Yeah, that was a tricky day, honestly. Tuesday was a tricky day. It's just one of those days where it's just like price action is dog. But Wednesday was super clean. Um, like I said, this is the previous Thursday accumulation high, delivering off of a 15-minute imbalance. So this is the 15-minute. We're delivering off of the CE of it, the 50% of it. So what can we assume now? So we want to see price start to disrespect bearish PD arrays. So this is the bearish fair value gap here. This is the bearish fair value gap here. Now there's two in this leg. Let's see if we can find a leg with one. So maybe on the 2 minute. Okay, not on the 2 minute. Now let's try to see if there's one on the 3 minute. I think it was one of those legs where, yeah, it's only on one time frame. Yep, it was only on the 1 minute. So I still have the recording, and I feel like pulling it up just so you guys can see me actually take this trade. I posted it in the live recordings chat, but price closes below this one with displacement, and I say I'm not going to take the trade until we close above the one in premium. So whenever you're forced to take a trade with two imbalances, you want to be taking a trade when price disrespects the one in premium. So you see how, I mean, if we're thinking premium discount, when there's a bearish PD in premium, that's like optimal entry, right? Like that's where shorts are going to work. Like you would expect price to come up here, tap into this, and then keep going lower, right? But if price disrespects it, you would assume, all right, it's disrespecting a bearish PD in premium. We're gonna at least deliver to this high, at least to this high. So this would be your TP1. All right, so now keep this TP1 in mind. With this in mind, once price closed above right there, you see this candle closure above, that was our entry right there. So we went long there. We had TP1 there, stop at 25 points. I believe I did my stop at 30 points just because it was FOMC and it's more volatile. But, um, And eventually, watch this. So once we implement standard deviations, which is like the cherry on the top, remember what I said about measurements? When price aligns with the standard deviations. Now look at this. If we take the last liquidity sweep leg, and you might say, well, this isn't really a swing. How would we know this is the last liquidity sweep leg? Remember what I said about order blocks and using them as the legs? We have an order block there, and then we have our displacement leg. So we can use wick to body on this one. Since the swing high isn't a wick, we use the body. And the first standard deviation lines up with TP1 right there. So this would be your first TP1, 31 points. That's super, super good. My TP was right here at the Thursday high, lining up with the 2 to the 2.5 right here. So that was a good 70 points, 67. I was targeting that. However, once price reaches TP1, this is usually when I go stop loss break even. You see price hit TP1 right here at 242. I went stop loss break even. Look at this candle right here. 244. We get stopped out break even right there on that wick. As soon as we get stopped out break even, price delivers back into our original entry, this inverse. Right there, it reaccumulates. Remember what I said about the first standard deviation? That's reaccumulation. Price reaccumulates, redistributes back up to the second standard deviation, which was back up to TP, the full closure right there, TP2. And that's when price started reaccumulating right there, and then once again started redistributing back up to the fourth standard deviation, which is where it started slowing down right there. But yeah, I went break even. Some members took profits there at TP1, but that's why it's important to, trim some at TP1. We've noticed that um our win rate on TP1 alone is like someone did it. I think it was Moz. It was like 98%. It was pretty crazy. And like the other losses were including like just going break even. But that's when it's important to just take profits at TP1 because that's when you can expect price to either tap into the first standard deviation and then reaccumulate or just reverse. So just be careful at TP1 and just take profits. I mean, at the end of the day, yeah, it's cool that you can potentially get a 70-point play, but I mean, 30 points is cool too. Um, that was Tuesday. But does the model make sense for you guys? Yeah, hell yeah, hell yeah. So yeah, essentially all the model is a 15-minute or 4-hour premise. So essentially higher time frame premise, lower time frame model. All right, so that was Tuesday. No, that was Wednesday. Almost done here. So this is Thursday. Let's see if we can find any higher time frame PD array. So Thursday makes the high of week. Now, when we make the high of week or high of, well, this is all-time high. But typically you won't find any other PD arrays past it. You'll kind of notice that. All right, what do I do now? There's really nothing to the left. Highs and lows also count as PD arrays. You'll find that you can find reversals there. So if we assume that price is going to reverse at the high, we can start to go to the lower time frame and look for a model. So this is the high right here. This is the all-time high right there. Equities opened literally at the high. So equities opens at the high right there, 9:30. And like I said before, at 9:45, I like to look for a reversal. So this is kind of a choppy open right here. It's not the best because we dip lower, we dip higher. I mean, we dip lower, we come up higher. So it's not the opening move isn't clear. So in times like this, I like to look for a few things. I like to look for a high and then a higher high to be made. Like in this scenario, we have a high and then we have a higher high, which means price sweeps liquidity and then sweeps it one more time. This is your low time frame liquidity sweep, like I spoke about. That's why it's part of the checklist. You want to see a low time frame liquidity sweep. Because if you just have a high time frame liquidity sweep and no premise behind it, like let's say you entered off of like this imbalance and you went short right here. Well, you don't really have a lower time frame liquidity sweep and you just get absolutely smoked right here on this leg. So now you always want to see a lower time frame liquidity sweep, so one more right after, whether in this scenario it's a higher high, but if it's on the lower time frame, you want to see a lower low be made. And then now you can begin to look for your lower time frame premise. So in this case, lower time frame liquidity sweep, higher time frame. This is your higher time frame sweep right here. Higher time frame sweep, lower time frame sweep, imbalances. So on the imbalance leg, the last one, if we look at this order block, it would be this displacement candle right here on the 1 minute. So we can say that it could have been this one right here, right? But, you know, if we say that this entire thing is the liquidity sweep leg, then there's two. So we'll use both scenarios. So, I mean, on the 1 minute, we can see that price closes below this one. Price closed below there. That would have been your closure entry, or you can be more risky and wait for the retracement back into the inverse. But you see how this wick didn't retrace back into the inverse. So in this scenario, you wouldn't have been filled and price just dips lower. So that's why it's kind of like there's pros and cons to entering off the closure, and there's pros and cons to entering off of the retracement back into the inverse. So that would have been your fill, targeting standard deviations. If you target standard deviations there, your TP1 would have been at this low. That lines up with the first standard deviation. So we can see there, this low lines up with the first standard deviation. And then second standard deviation right here. That's the reversal, but does it line up with the low? It lines up with, well, we have relative equal lows. You guys see these two lows right here? Those are relative equal lows. So that would personally be my target right there. So this honestly is not bad. Not that bad of a trade right here. So entry here, stop loss 25 points. Targeting TP1 would have been at 22 points. So that's 23 points actually right there. And then full closure at 47 points. So a good 2R right there on that trade. But let's say you didn't want to use this leg. Let's say you wanted to use a leg with only one imbalance. So now let's look at that. Let's go to the 2 minute. On the 2 minute, oh, there's a tiny little 2 minute imbalance here. Price does close below it. So let's say you enter off of this one right here. Actually, let's see if it's on the 3 minute before we dive into the 2 minute. Okay, yeah, it is on the 3 minute. Very nice. Right there. Is it on the 5 minute? Not on the 5 minute, just on the 3 minute. Alright, so when you see one, kind of like cycle through time frames and see, okay, is it on the 2 minute, 3 minute, 5 minute? The higher time frame it is, the stronger it'll be. So you see how here on the 3 minute, it closes perfectly right below it. This is like a perfect fill right here. Stop at 25 points. TP, now you can use, I mean, the standard deviations would be a little bit more different because now you're extending it longer. So now the first standard deviation, which would be TP1, would be down here. So you get more of a move. So this is a low right here. This is the low you would be targeting. And when the measurement, meaning when the standard deviation lines up with a low, that's a good low to target. So this would be the low you target right here. Is this the play we caught in a build? I think we caught this play. It looks way too clean not to catch. Oh yeah, we did catch this one. Yeah, yeah, yeah. I think we did. I'm trying to look back on the daily trade recaps. I don't think I posted it on the daily trade recaps, but we did catch this one. Yeah, yeah. Anyways, yeah, we closed below the 3 minute. And then you target, I mean, if it's a 3 minute model, then you take the 3 minute standard deviation. But if you take it on the 1 minute, then take the 1 minute standard deviation. That's just a good rule of thumb. This is a nice 43 point play right here. Very beautiful, honestly, very beautiful. Now let's say you're trying to catch, you don't catch the, because I see a long opportunity. Let's say you don't catch the short and you're trying to catch the long. Good way to expect a reversal, you could also use standard deviations here. So let's say you go on the 1 minute. I'm gonna teach you guys how to frame each standard deviation frames the next. So what I mean by that is, where is it? It's right here. So let's use just the bodies. All right, right there. So now that we know where the standard deviations can be framed, so now right here we have a swing. So from swing low to swing high, this is the last leg that sweeps liquidity. Now, if we expect a reversal here, we would expect it at the 2 to the 2.5, which is just coincidentally right there where it taps into it. And this standard deviation right here would frame this standard deviation right here. What I mean by that is now on this liquidity sweep leg, you can frame the next one to go higher. And this is how you frame. So like this standard deviation frames this standard deviation if you're trying to catch a reversal, and you can find a model off of this one. So last liquidity sweep leg here. If you just want to scalp, and there's like another way to do this, you don't always have to wait for a higher time frame PD array. But this is your last liquidity sweep leg because this is a high that was made, and this is the low of the leg. So this is one leg right here. There's an imbalance right there. Price closes above it. This would be my personal entry. I wouldn't catch the retracement. This would be my entry here. Price close goes above. And from here you would target standard deviations. Now, both of these highs right here, these two highs line up with the first standard deviation right here. So I would personally target that right there. So that's just another like, that's just some more sauce for you guys. If you like, each standard deviation frames the next one. Right there. 25 points isn't so down here. So that's a pretty good R to R right there. That's 1.5, but let's say you did it at the low. That's close to 2R right there. So you catch one in the morning, maybe you even catch one closer to the afternoon, and then, that's two plays. But typically for me, once I catch one winning trade, I call it a day. Need a bit more time, but it's good. I'll start paying more attention to IFEGs as confluence. Hell yeah, bro. Use it like I first started using them as confluence because I used to trade breakers, and within every single breaker block, there's going to be an IFEG. And then I started actually using the IFEG, and then I started catching better fills. Like the breaker, if you really think about it, like if we look at only breakers, like this right here is a breaker, right? And then we would only enter off of the close below. But within the breaker, there's going to be an IFEG. Remember what we talked about? There's this one, and then there was like, I think there was one below right here. Um, I think there was one right here. So like the breaker you get, I mean, it's like the breaker works, but you're just getting a better fill with the IFEG. So like I started using them as confluence at first, and then I was like, damn, these actually work. So then I started actually trading off of them, and then my trading blew up. How often do you implement SMT? I only implement it when we tap into a higher time frame PD array. For example, I'm curious as to if this Thursday high, when we swept liquidity here on the 1 minute, I'm curious if we made SMT there. See, like I use SMT. You see how like I mark it out? Like I use it, but it's not as often as you would think. This is Friday. Let's see where Thursday is. Ah, see, so I did use it. I still have it marked out right here. I still have it marked out. So this was right here. And there was SMT actually, I think. No, there wasn't. There wasn't. There was SMT in the PM session. So I think this was a 5 minute model. So if we go on the 5 minute, okay. All right, let's break this down, boys, because this is important. This is SMT right here. Let's break this down. So what do you guys notice about these highs right here? Obviously, I mean, it's pretty obvious now. I already marked it out, but SMT, SMT, right? So NQ does not take the high. ES takes the high. All right, and this was actually Beautiful model setup right here. Um, so with this in mind, we can assume that ES, like I already marked out right here, I mean, this is not in hindsight, like this was marked out on the day of, but ES formed manipulation on this liquidity sweep, NQ didn't. So what does that tell us? That tells us, all right, on this liquidity sweep leg right here, from 1210 low, which is specifically this low right here, to from 1210 to 1230, that leg right there, that leg was manipulation on ES, but on NQ, that same leg was accumulation right there. So what does that tell us? That tells us we're going to go lower, but how do we find a model off of this? We literally use the same exact model that we implemented on the lower time frame, on the 1 minute, the 2 minute, the 3 minute. Now we're using it on a higher time frame here. We're using it on the 5 minute. So let's take that liquidity sweep leg with standard deviations. But it's not really a liquidity sweep leg, Kislev. Like, we didn't take the high. Well, we did on ES, so you're valid. It's valid to use it on NQ, even though we didn't take the high on NQ right here. So this high right up here, we didn't sweep it, but on ES we did. So that same leg is valid for NQ the same way it is for ES. All right, so with this in mind, we look for standard deviations, but on the 5 minute, there is no, on the liquidity sweep leg, there is no imbalance. So I'm going to look on the macro perspective. I'm going to look on this liquidity sweep leg right here. Do we have an imbalance? We do. We have two. And past the 5 minute, I don't really like going to the 15 minute for entries. It's very rarely that I do. But right here on the 5 minute, what happens here? We close below it right here. We tap into, what do we tap into? The first standard deviation. What does the first standard deviation tells us? We're going to reaccumulate and we're going to redistribute. So we reaccumulate right into that inverse right there. So this is your bearish inverse. That would be your entry. Why would that be your entry? Well, you wouldn't enter off the close because the fill is shitty. It's too far off the entry. So you would catch the retracement after price taps into the first standard deviation. You would catch the retracement back into the inverse. So that you would set a limit order right there. And you know the measurement is correct when a low lines up with your standard deviation. You see how this low right here lines up with the 2 to the 2.5? So you would either take full TP there, or you would even take it right here. 3.5 to the 4, which is where you expect a reversal. Price taps into the fourth standard deviation here, and then it reverses right there. But yes, I do use SMT every, so you most likely mark it out at the smart money reversal. Yeah, I mark it out at the high. Like, I don't really pay attention to internal SMT. Like, if price makes SMT at internally, I don't really look at that. I like to look for external SMT. That'll give me the high or the low of the market maker model. This is a market maker sell model, by the way. Hell yeah. Well, looks like everyone left. You guys want to do Friday and then call it a day? One more day. Let's do Friday. All right. So Friday, do we have any PD arrays? I mean, we're retracing back into the range. So how do we use this now? Same exact thing. Go on the 4 hour. And now we look for 4 hour internal PD arrays. We do have external, which would mean like the FOMC, or maybe like this one right here. But this one was already tapped into at 2 p.m. on Thursday. Remember, it's Friday now. So 2 p.m. and 10 p.m. on Thursday. It was already tapped into. So it's already been, I guess you can say, touched multiple times, pause. But what that means is it's becoming weaker the more times the imbalance has been tapped into. Because remember, an imbalance simply is just displacement of a candle. So if we look at it in a volume profile type of way, if we look at it in a volume profile type of way, there are multiple orders within this imbalance, this displacement leg, that were not filled yet, right? Because price is moving up, it's displacing. The line is thin here. So you know when you pull up a volume profile, I know there's a fucking if we want to get real anchored volume profile. All right. So from here, all right, whatever. Yeah, this will do. You know when you pull up a volume profile and it's like there's like a saturated amount in one area because price is revolving around that one area a lot. And then there's always like the thin amount of like there's always like a thin layer of orders, of volume, I guess you can say. Now, if we look at it in an imbalance perspective, on an imbalance, they're super thin because price is saturated here, price is thin here, price is saturated here, saturated here. So what is price going to do? It's going to seek fair value because this is fair value right here since it's thin. It's going to seek the thin area. It's going to saturate it. It's going to seek, once again, the thin area. It's going to saturate it. And it's going to... Does that make sense, guys? It's more of like a, I don't know, more volume-based approach. But yeah. Kiss is spitting. All right. Anyways, guys. So yeah, since this bullish 4 hour was already touched multiple times, we're not going to be looking for a bullish bias. Once again, it's already, remember, weekly profiles. We made a Thursday high of week. We would expect Friday to deliver back into the range. So this is Friday at 2 a.m. So from the 4 hour, we go to the 15 minute. We're already delivering off of a 4 hour overnight. So, I mean, unless you traded like London session, this would have been a beautiful setup right here. This would have been beautiful. You have a 15-minute internal high being taken, 4 hour PD array. Is there a model up here? Internal liquidity sweep. Do you guys consider volume imbalances as an imbalance? I don't. I personally wouldn't have taken this, but there's a close below there. Is there a fair value gap? There isn't one until down here. So I guess a close below that, that would be your, I guess right here, 25-point stop. Oh, you're chilling. That's a very cozy stop. And then you target standard deviations. Maybe down here. Alright, yeah, so that aligns. You could do this low, lines up with 3.5 to the 4. Just catch this banger right here. So, but that was overnight. We don't really trade overnight. Oh, I don't. I mean, maybe you guys do. You see how like the model is even formed during London session? Like it's everywhere. Let's go to the 1 hour because I think this was a 1 hour delivery. So I mainly use the 4 hour, but sometimes the 1 hour can even give you a setup right here. So we're delivering off of a 4 hour. We go to the 1 hour, and market opens at 9 a.m. delivering into a 1 hour. So price is bearish. 4 hour, 1 hour. Let's drop down to the 15-minute. All right, price taps into, so this high right here, I believe this was, yeah, that's 10 a.m. high. Let's go to the 5-minute. So yeah, so we have a 15-minute PE right here. We have that one, and then I believe we tap into the one in premium. So this one right here, yeah, we do tap into that. Let's go to the 5-minute. So we're just doing top down right now. So 15-minute, 5-minute. All right, market opens 9:30. Market opens right here. All right, so market opens here. Now we're bearish. We're looking for a bearish setup because we're delivering off of a 1 hour and a 4 hour. With this in mind, price taps. So we're gonna wait for the 15-minute tap. All right, we're gonna wait for the 15-minute tap because remember it goes 4 hour, then 15-minute. So 15-minute tap, and then we go to the 1 minute and we look for a setup. Price taps into the 15-minute right there beautifully. Now on this liquidity sweep leg, oh, this was the trade that we went break even on a build. It's in the daily trade recaps if you guys want to look at it. But this was a banger, bro. This was a banger. It was a 3-minute setup. I remember this vividly. It was a 3-minute setup. Yeah. So price taps into the 15 minute. Notice the 3 minute has one imbalance right there. The 3 minute has one imbalance. This is actually news release right here. Was it news release? No, no, it wasn't. Thursdays was news release. And 9:45. I remember taking that one because I remember Moz is like, "Oh, you're gonna take it on news release or something like that." And I was like, "Yeah, fuck it. I mean, it's the model." This one right here, we closed below it. I entered off the retracement. You see this wick? We tap into it and we keep retracing higher. I remember I took this one on the retracement because Moz, I mean, it was hate. Hate was like, I love being in drawdown or something like that. But it was just simply the retracement. And I said, well, just wait for the 3 minute closure. That's going to tell you the power of three of the 3 minute. You see the power of three of this 3 minute? Open, high, low, closed. So you always wait for the close. Wicks do the damage, bodies tell the story. Alright, so now where can we target? We can target this internal right here, which is like zero, I mean almost close to zero profit. I mean, what is that? Like 16 points. I mean, I like to go for closer to like 50-point plays. So this is what I was targeting and always take the measurements. Remember what I said about if the measurement lines up with a low, you target that? This was the target right here, boys. This was the target. Dude, like this is actually sad just looking back at it. 25-point stop, which is at the high. TP was at 42 points. And this is the target. But what happened? Price delivers, we're up, we're just like celebrating and shit, and then market reverses. I've seen this multiple times before. I'll say it once and I'll say it again. When price starts consolidating closer to a low and it forms this model, right? You see that, like you see how it formed an internal model? Remember what I said? When price forms a low and then it makes a lower low and it forms an internal model. So it basically manipulates lower right there. You're gonna expect a reversal, and that's exactly what it does. I was telling Maz, I'm like, I'm actually gonna exit here. He's like, why are you gonna exit? It's already at TP, just hold. And I was like, all right, bet I'm a hold. And then price goes back to break even. We get I mean, it's like if we wouldn't have taken a trade, but when you're up like 100 and what was that? When you're up like 159 ticks, I mean, you're gonna be pretty bummed out. But this is an A plus model right here. I love this model. Um the model itself, and then Friday was honestly this is like a B setup right here because we're delivering off of a 1 hour instead of a 4 hour. No real difference, just that the 4 hours are stronger. I prefer 4 hours. If it's delivering off of a 4 hour, then I consider that like a A plus setup. If it's like a 1 hour, then it's like A minus, maybe like B plus. This one up here was an A plus because it's off a 4 hour, 15-minute internal high swept, and then you have your internal model there. But that was Friday. That was the play of the day Friday. We got stopped at break even, price reverses, and then whatnot. And then I believe, okay, we'll do this last one because I saw this one PM session. That was AM session. This one PM session, also off a 1 hour, right there. All right. And typically from the 1 hour, you don't go to the 15-minute. That's only on the 4 hour. If there's a 4 hour PD array, you go to the 15-minute, look for a 15-minute high or low or a PD array. From the 1 hour, you go to a 5-minute. All right. And you look for any 5-minute PD arrays or highs or lows. And there was a 5-minute right there. All right. So that 5-minute high right here was swept right there. And there's a 1 hour PD array. So that's a model right there. Let's go to the 1 minute. Maybe there was SMT right here. I think I did mark this out. I didn't. Never mind. There was SMT on that first play we did, actually. 3-minute play we did. There was SMT there. These highs, there was no SMT. Never mind. All right. So, any, yeah, we do have actually. We do have one. So, internal low, that's the swing low. And then we have the swing high. Do we have an imbalance on the liquidity sweep leg? Yes, we do. Entry on the close below. Stop loss. Damn, 25 points. That's a good amount of cushion there. And then targeting your standard deviations. Notice how the 2 to the 2.5 lines up with the low. So TP1 would be this low. This would be your TP1. TP2 lines up with the second standard deviation. That would be your TP2. Good 29 points PM session. But yeah, almost zero drawdown. Almost all TP. But that's gonna conclude it for today, boys. That's the model. Literally stupid simple. And I kind of just wanted to do this for you. Like not that many people joined. There was like 10 people interested. Like max like 5 people joined out of the 10 people that were interested. But Vincent and Quicks, appreciate you guys for staying. Zed, thanks for just dropping by. Yeah, real G, show up, man. You guys want to learn for sure. But yeah, do you only look for SMT on ES? Some people also look at I like if there's SMT with the Dow, I don't look at the Dow, I'm gonna be honest. Only with ES. What about when oh shoot, what's up, bro? Bet. Yeah. Well, you heard it from the build the man himself. He uses YM, so I don't, he does. Personal preference. I mean, really. Sometimes I don't think SMT is that important. If it's there, it's like the cherry on the top, you know? It's like, damn, we have SMT. It's gonna work now. It's like more of a confluence rather than like a make or break for me. What about when you get 50% of consequent encroachment of a fair value gap? We went over that on Wednesday when price tapped into the consequent encroachment of a 15-minute fair value gap and it modeled a 1 minute model. So yes, it's important you use them with the higher time frames. 50% of the higher time frame fair value gaps are strong. W live instead of the 5 minute, do you go to the 3 minute? Yeah, we went over that, said. We went over that. You were just a little, I don't want to call you out, but you were just a little late. I'm recording this right now, so you can go back and review like the time frame alignment part. Um, any difference between 1 hour 50%, 50-minute 50%? No difference. Just remember, price is fractal, so they're the same. They have the same qualities, tendencies. Just that one is on a 1 hour, one is on a 15-minute.